Investment banking is a critical component of the financial services industry, providing companies and governments with financial advice and support on a wide range of issues. Investment banks play an important role in the global economy's growth and development, from initial public offerings to mergers and acquisitions. Hello everyone, and welcome to this video by Intellipaat. So, investment banking is a highly competitive and dynamic industry with numerous career opportunities. Having a solid understanding of investment banking is essential whether you're a recent graduate looking to break into the industry or an experienced professional looking to advance your career. We have provided a list of common interview questions that you may be asked during an investment banking interview, as well as tips on how to effectively answer them. So if you're looking to take your career in investment banking to the next level, this video is for you. So let's get started. But before we begin, make sure you subscribe to our YouTube channel and hit the bell icon for regular updates from us. So let us begin by looking at investment banking beginner interview questions. First, what are the three financial statements? First is income statement. The income statement is a financial statement that shows the profitability of the company. It begins with the revenue line and works its way down to net income after various expenses are deducted. The income statement is for a set period of time, such as a quarter or a year. Second is balance sheet. The balance sheet does not cover the entire period, but rather provides a snapshot of the company at a specific point in time, such as the end of the quarter or the year. The total number of assets and liabilities must always equal the total amount of equity and liabilities. Third is cash flow statement. A cash flow statement is a magnified version of the balance sheet's cash account that accounts for the entire period, reconciling the cash balance at the beginning and the end of the period. Next question is, what is the difference between enterprise value and equity value? So enterprise value is the company's overall current value, whereas equity value is the value of the company's shares and loans, which can provide an indication of the company's current and future value. Third question, what is beta and how to calculate beta for a company? The beta of investment security is a measure of its volatility of returns in comparison to the market as a whole. It serves as a risk indicator and is crucial to the capital asset pricing model. A higher beta means a greater risk and higher expected profits for the company. Because 1 is the benchmark for beta, everything above 1 is more variable and carries more inherent risk. Next question, what is the difference between a merger and an acquisition? A merger is a combination of two or more commercial companies to form one joint entity with a new management structure, ownership, and name that capitalizes on its competitive advantage and synergies. In contrast, an acquisition occurs when a financially powerful entity acquires all or a portion of the total shares of a less financially powerful commercial firm. Next, what is DCF? The term discounted cash flow refers to a valuation method that determines the value of an investment based on its expected future cash flows. The purpose of a DCF analysis is to determine the current value of an investment based on projected future earnings. It can assist those deciding whether to acquire a company or buy securities in making the decisions. Discounted cash flow analysis can assist business owners and managers in making operational and capital budget decisions. Next question, how do you value a company? A company can be valued in three ways: comparable company analysis, discounted cash flow analysis, and precedent transaction analysis. First, comparable company analysis. It entails locating companies that are similar to the one under consideration and comparing their EBITDA, stock price, and price to earnings among other variables. Next is DCF. The discounted cash flow analysis uses the amount of money that the company is expected to make in future, discounted to present values. Finally, precedent transaction analysis. Precedent transaction analysis is similar to comparable company analysis, in which you look at how much similar companies have sold in order to determine the value of the company you're valuing. Next question, how do you calculate terminal value? Terminal value is the estimated value of a company after a certain period of time and is a key component of DCF analysis. There are two methods for calculating terminal value. First, the growth in perpetuity method and the exit multiple method. The growth in perpetuity approach assumes that cash flows will grow at a constant rate indefinitely. The exit multiple approach does not assume perpetual growth, but rather examines the net value of a company's assets at a given point in time. It is used to describe a company that will be acquired or liquidated in the future. Next question. When should a company issue debt instead of equity? Because the cost of debt is typically lower than the cost of equity, there are many situations in which issuing debt makes more sense than issuing equity. Issuing debt rather than equity makes sense if the company can benefit from the tax breaks by issuing debt, the company has consistent cash flows and can pay interest. As a result, the WACC is lower, and with more financial leverage, the company can get a better return on investment. Next question. What is the PEG ratio? The PEG ratio is an abbreviation for the price earnings growth ratio, which includes the PE ratio as well as the EPS growth rate of a company. Rapidly growing stocks have higher PEG ratios, whereas conservatively priced stocks have the same PE and PEG ratios. If a company has the same PE and PEG ratio, one could argue that its stocks are overpriced when compared to companies with the same EPS but a lower PE rate. Next question. What is net working capital? Net working capital is the amount of money a company has after paying off all current short-term debts. So it is given by current assets minus current liabilities. So current assets include balance sheet items such as accounts receivable, inventory and prepaid expenses, whereas current liabilities are short-term debts such as accrued expenses, deferred revenue and accounts payable. Now we're going to look at investment banking intermediate interview questions. Starting with the first one, what does negative working capital mean? When a company's existing liabilities exceed its current assets, it has negative working capital. This means that liabilities paid within a year outnumber monetizable working capital during the same time. Buyers frequently regard a target company's negative working capital as negative because it represents the additional capital required to operate the company after the transaction is completed. A buyer prefers a working capital ratio of 1 to 1.5, which means at least $1 in current assets for every $1 in current liabilities. This gives the buyer confidence that the company will be able to meet the seller's and payroll obligations in the short term. Second question, what is the difference between cash-based accounting and accrual accounting? So cash-based accounting records revenue and expenditures only when cash is received or spent. Accrual accounting, on the other hand, records revenue when it is reasonably certain that it will be collected and expenses when they are incurred rather than when cash is actually spent. Because credit cards and lines of credit are so widely used for payment these days, most large organizations use accrual accounting. However, very small businesses may choose to use cash-based accounting to simplify their financial statements. Next question. Two companies are identical except one has debt and the other does not, which will have a greater WACC. The company with no debt will have a higher WACC because debt is less expensive than equity. Debt interest is always tax deductible. Debt is ranked above equity in a company's capital structure, which means that debt holders would be paid first in the event of bankruptcy or liquidation. Contrary to popular belief, debt interest rates are typically lower than equity cost of equity figures, which are typically higher than 10%. As a result, the cost of debt component of WACC will account for a smaller portion of the total than the cost of equity component. Fourth question. Give an example in which you encountered a difficult situation while working in a group. So you can frame your answer in a way by saying, during my senior year internship in financial management, I worked in a variety of small groups. Each student had a very busy schedule and I took the initiative to help everyone reprioritize their schedules and find areas to compromise. This aided in the group in balancing workload and work quality. In the same situation, there was a member of the group who was not carrying out his responsibilities, and I contributed to the solution by assisting him in discovering his strengths and allowing him to focus on them while the others filled in the gaps. Next question. What is terminal value and how do you calculate it? So terminal value is the value of a company, project or asset after a period for which future cash flows can be predicted. So terminal value assumes that a company will continue to grow at a certain rate indefinitely after the projected period. The terminal value is calculated using the following formula, where FCF stands for free cash flow for the last forecast period, G stands for terminal growth rate, and D stands for discount rate. Sixth question, how is the balance sheet adjusted in an LBO model? The additional debt is first added to the liabilities and equity sides, and then the shareholders' equity is wiped out and replaced with the maximum equity contribution from the private equity firm. After cash on the assets is adjusted for and any cash is used to fund the transaction, goodwill and other intangibles are used as a plug to make the balance sheet balance. Depending on the transaction, there may be additional implications such as adding capitalized financing costs to the asset side. Moving on to the seventh question, what is the difference between high yield debt and bank debt? Some of the major differences are, high yield debt has a higher interest rate than bank debt. Bank debt interest rates are not fixed like high yield debt rates. They fluctuate based on the Fed interest rate and LIBOR. Maintenance covenants apply to bank debt, whereas incurrence covenants apply to high yield debt. The main difference between the two is that incurrence covenants prohibit you from taking certain actions, whereas maintenance covenants require you to maintain a certain level of financial performance. For example, the debt or EBITDA ratio must always be less than 5 times. And finally, in case of bank debt, the principal must frequently be amortized over time. However, in the case of high yield debt, the entire principal is payable at maturity. Eighth question, determine if an acquisition is accretive or dilutive. So this is an important question whenever a company considers acquisition. Fundamentally, any transaction that increases the buyer's earnings per share is accretive. Any transaction that reduces the buyer's earnings per share is dilutive. So here's a quick rundown of how to respond to this question. Inquire your interviewer if the deal is all stock, and if the transaction is all stock, it is simple to determine whether it is accretive or dilutive. It is accretive if the buyer has a higher PE ratio. It is dilutive if the seller has a higher PE ratio. Ninth question, what is an LBO and what are its value drivers? A leveraged buyout is a debt-financed acquisition, typically a very high percentage of debt. The following are the primary drivers of an LBO's success or failure. First, the cost of acquisition, then the amount of debt used and the debt cost, and finally the anticipated exit price. It is also worth noting that the actions taken by the acquiring firm to increase the exit price of the target business have a significant impact on the success of an LBO. Successful LBOs, for example, typically involve expanding or restructuring the business to increase its value. 10th question, what is the difference between goodwill and other intangible assets? When a company is purchased, a goodwill premium is paid over the fair value of assets. As a result, it is linked to a company or business and cannot be purchased or sold on its own. Other intangible assets such as licenses and patents can be sold and purchased separately. Moving on to investment banking advanced interview questions. Starting with the first question, what is the distinction between capital and operating leases? Operating leases are used for short-term leasing of property and equipment and do not involve any ownership. Operating lease expenses are shown on the income statement. Capital leases are used for long-term items to provide the lessee with ownership rights. They depreciate, require interest payments, and are classified as debt. Second question, explain an IPO valuation for a firm that is about to go public. We only consider comparable public company IPOs as opposed to traditional valuations. We choose comparable public companies, apply the most relevant multiple, and base our estimate of the company's enterprise value on that multiple. We can calculate the equity value by working backwards from the enterprise value. We also consider IPO profits because they are new funds. The price per share is then calculated by dividing the total number of existing and newly issued shares by 100. This is what it means when people say an IPO is valued at. Third question, tell me about major items in shareholders' equity. The first is common stock. The most common type of stock in which most people invest is called common stock, which represents a portion of a company's ownership. Second is retained earnings, the amount of net income that the company has saved up over time. Third is treasury stock. The monetary value of the corporation's shares are purchased. Finally, additional paid in capital. This accounts for the number of new shares issued as a result of employees exercising their stock options as well as the amount of stock based compensation granted. It also considers how much additional money a company receives from an IPO or other equity issuance. Next question, in a DCF, why would we use the mid-year convention? This is because a company's maximum cash flow does not always occur at the end of a fiscal year, but can occur evenly throughout the year. We would use the discount period numbers of 1 for the first year, 2 for the second year, 3 for the third, and so on if there was no mid-year norm. Instead, with the mid-year convention, we use 0.5 for the first year, 1.5 for the second, 2.5 for the third, and so on. Next question, what are your strengths? If you are asked this question, this is one of your best chances to demonstrate why you would make an excellent banker. Your analytical, quantitative skills, communication skills, the ability to learn quickly, detailed orientedness, and ability to work extremely hard are likely to be highlighted. You should be prepared to back up what you say about your strengths with one or two concrete examples from previous jobs or school. Next question. Explain the use of revolver in an LBO model. A revolving credit line is used when you need more money to make your mandatory debt repayments than you have available. The revolver, like credit cards, begins undrawn, which means you don't borrow money and don't accumulate debt unless you need it. Before calculating mandatory and optional debt repayments, add any required revolver borrowing to your running total of cash flow available for debt repayment. You assume that any revolver borrowing from previous years is paid off first with surplus cash flow before any term loans in the actual loan repayments. Seventh question. Why are deferred tax liabilities and deferred tax assets created in the merger and acquisition transactions? These are generated as a result of the writing up and writing down of assets in a transaction, which include both tangible and intangible assets. An asset write down generates a deferred tax asset, while an asset write up generates a deferred tax liability. Because of the frequent differences between an asset's fair market value and its book value, which appears on the balance sheet, the asset must be written down and written up. A write up of an asset results in a deferred tax obligation because the new item will have a higher depreciation expense, which means you will pay less in taxes initially but will have to pay them back later, resulting in the liability. For an asset, write down and a deferred tax asset, the inverse is true. Eighth question, how do you approach problem solving in a complex financial scenario? You could answer this question by saying, when faced with a complex financial scenario, I follow a structured approach to problem solving. First, I gather all the relevant information and data. Then I analyze the information to identify the root cause of the problem. Finally, I evaluate various options and make a recommendation based on my analysis. I always ensure that my solution is feasible, practical, and aligns with the client's objectives. Next question, can you walk us through a recent transaction you worked on? So you can answer this question by saying something like, yes, I worked on a deal for a company and my responsibilities included conducting due diligence, developing financial models, and negotiating the terms of the transaction with the counterparties. The transaction was completed successfully and it was a valuable learning experience for me. And for the final question, what are some of the examples of non-recurring charges that are reflected in the company's EBIT or EBITDA when reviewing its final statements? First, goodwill detriment, then charges for restructuring and asset depreciation, legal expenses, expenses related to bad debt, accounting procedures have changed, expenses associated with a disaster. And with that, we have come to the end of this video. Thank you for watching.
Just a quick info, guys. If you want to make a career in investment banking, Intellipaat has just the right course for you. Enroll in the advanced certification in the investment banking operations by ENICT Academy, IIT Guwahati. Learn from the industry veterans and academic pioneers and fulfill your dream of becoming an investment banker. Enroll today.